Travis, today we're going to discuss something many investors don't always consider until it's too late, and that's concentrated stocks.
Correct.
Concentrated stock positions can feel like a blessing, especially if it's a lucky stock or you have stock options or an inheritance. However, there is tremendous risk in being over-reliant on one stock's performance, right?
There is, for ssure. Yeah.
And so people around here do remember the Enron debacle on level 3 pretty well, and I know that ages us a little
If you've
bit.
been in the business a while, you remember that era. So, Steve, when a single stock dominates your portfolio, you're obviously at the mercy of that company's success and failure, as you pointed out with the Enron and level 3. So if that company hits a rough patch, obviously you can be in trouble. Another challenge we see is if that stock has made a significant portion of your wealth, it's made you wealthy, it's easy to become emotionally attached. It becomes part of your identity, maybe from a company you worked at for a number of years, a long time. But we know in this business, emotions can cloud judgment, and that's where people make big mistakes, is when they get emotional. They hold on too long, they fear paying taxes on capital gains, and then they get burned when the stock dives. You just gave me some bad memories of the whole level 3 debacle back in the day.
Yeah, those were tough years. It's tough. Capital gains taxes are a genuine concern, especially for those with low cost basis.
Sure.
But holding on to a concentrated position just to avoid the tax burden that you're going to incur can even cost you more eventually. Fortunately, there are various alternatives, though, to manage the concentrated positions. And one is called a collar that involves options and basically selling away some of the upside to buy some insurance. So when you have those drawdowns on that stock, you're protected against the downside. And it reduces your risk to the large individual stock drawdowns that we see in the markets.
Yeah, I mean, a collar, it sounds complicated. It's really not. It's a fairly basic strategy.
We've done it with our clients before in the
Right.
past.
Another strategy, to consider here too is just creating your own custom index. I mean, that strategy aims to generate returns of whatever underlying index you want to replicate. S&P 500, Russell 3000, et cetera. While continually harvesting, capital losses on the individual positions that you have in the account along the way. So if you fund the custom index account with your concentrated stock position and some cash, you can gradually diversify the portfolio. As you realize those losses in some of the individual positions, you can sell parts of the concentrated stock position, and that'll offset the tax burden of those capital gains taxes. And that creates a smoother transition into a diversified portfolio, helps reduce tax liabilities, over time, which is what most people want, right?
It's so true. And speaking of gradual, another simple option is to sell pieces of your stock slowly over time. This spreads out the tax burden, and reduces your risk over time as well. So you just don't have to sell that stock just all at once.
Yeah, generally set a schedule there, right? Take the emotion out of it.
It really does.
Yeah, spread the burden. And gradual diversification, along the way, Steve, helps, again, avoid making emotional decisions. Because at the end of the day, diversification isn't just about managing risk. It's about giving yourself a more stable, predictable return over time, which everyone likes.
Absolutely.
And, so if you're sitting on a concentrated stock position, don't wait until it's too late. Talk to your advisor now, make a plan, protect your future. Even if you think you're going to have a concentrated position, get ahead of it, right? Have a strategy ahead of time.
That's so true, Travis. It's been great. I look forward to it next week.
Look forward to it as well.